I think early on, what I realized was I'm not going to get enough cash flow to significantly change my life unless I scale hugely and change all my operations. Equity bumps are a great way to change your life. And over time of building a portfolio and owning a portfolio and building some businesses and losing some businesses, I realized that cash flow is really just a byproduct of net worth.
And you have just tuned into the 0 to 100 podcast. And I've got my co-hosts, Mr. Mitchell England and Gabriel Hamill. And we've got an amazing guest today. But before we get into that guest, if you're wondering, what the hell am I listening to? The 0 to 100 podcast is all about scaling in real estate. How do you grow a real estate portfolio that generates passive income? To get you to retirement number one, that's R1, where all of your living and lifestyle expenses are covered by said passive income. And how do you do it responsibly? How do you do it quickly? And how do you have a lot of fun doing it? So that's what we're all about. And today we are interviewing a personal friend of ours, Mr. Mike Nuss. Mike Nuss is a real estate ninja. He's an educator and an Oregon native with over 20 years of experience as a licensed appraiser and a deep passion for all things real estate. He's been investing since 2005 and has been leading investors since 2012. Mike is the founder of Rarebird Acquisitions, Rarebird Real Estate, and Rarebird Property Management. I want to get into that name, by the way, which he is building a vertically integrated platform serving investors across the Portland, Oregon metro area. He's also founded Investor Lab, a collaborative collective of badass real estate investors committed to growth and connection. We've actually spoken to Investor Lab and hang out with those guys. They're great. With hands-on experience in small-scale development, both single-family and multifamily, historic preservation, land development, and seller financing, Mike brings a rare depth of knowledge and energy to every deal and conversation. So we're excited to have the conversation with you today, Mike. Welcome to the show, man.
Thanks for having me. That was well read.
Yeah, Mike, how do you feel hearing about yourself like that? What does that feel like to just hear all that good stuff?
I need to use ChatGPT and narrow that down a little bit, make it a little more succinct.
That was the narrowed down version. Yeah.
I like the content. I just don't want to hear Travis talk that much. I was like, oh my God, how long do we have to do this? But it's an amazing bio.
It's too early for Mitch. Yeah, no, I think Gay was saying, I think that was your bio condensed down even more using AI, right?
Yeah, it was. But Mike, you've done a lot in 20 years. We've actually, some of you guys that have been listening to the 0 to 100 podcast show for a while, you may have heard Mike. We had Mike on very early before we were up and running professionally, like the professional podcasters we are today. Mike actually was on one of our early recordings, but it was, we didn't have proper equipment. Travis and Mitch always looked funny on camera. So yeah, we thought we'd bring Mike, we thought we'd bring you back on and let you share your story.
If we're professional podcasters now, then the state of podcasting in the world it's sad, right? I think if we're professional.
All right, let's let Mike talk. Mike, you real estate investor, 20 years. I know you personally, I've known you for a while now. But let's talk like pre-real estate. Like, how'd you get into real estate? But what were you doing before real estate?
Little baby Mike. What was going on with little baby Mike?
Yeah, I was in high school playing baseball and football. That was essentially, I had a paper route when I was young. I used sports to stay in school because I hate school. I really dislike being in a classroom. And then one day playing catch with my uncle in the backyard, he offered me a job working for him as an assistant appraiser. So I actually got into real estate appraisal while in high school, job shadowed him my spring break, and then finished out the school year working weekends, and then moved to Portland right after graduation and got into real estate appraisal. So that's kind of all I know. I know more about real estate than anything else.
Dude, what a great way to learn. So were you appraising single family houses as a high schooler, or were you appraising commercial real estate?
Yeah, all single families, all mortgage work. So, 99% of the jobs are just mortgage related, 1 to 4 unit properties. That's all I ever got licensed for. It's a great fundamental skill, not for the reasons that most people think. The best reason it's a fundamental skill is because you're taught to understand everyone's bias. What does a renter think, a seller, a buyer, a realtor, an inspector? How does everyone think? So that way you can put yourself in everyone's shoes. Because at the end of the day, being a weatherman in the appraisal world, all you're trying to do is say, hey, this is what a typical seller would want and expect and feel. This is what a typical buyer would want, expect, and feel. All these professionals that are going to be giving them advice. And then you come out with a valuation on the back end. So that was the best part of it, because as a real estate investor and owner of all these different companies, what matters most is other people's opinion, not mine. You know, the design of what we do doesn't matter. We were in a broker call today. We're looking at all these new floor plans we designed, and one of the brokers are asking me all these questions, and my answer is, I don't know. I leave that up to the architect.
That's a wild take, because Mitch, right before you got on, was talking about how he cares about no one's opinion except for his own. So I like kind of having the yin and yang on here.
I didn't say that, but I do believe that, Gabe. I appreciate you reinforcing.
Mitch is a legend in his own mind.
Here's the thing is, I like the opinion if it benefits me, but if it's against me, I'm like, I don't know about that.
You're so different off camera, Mitch. You're so different off camera. This guy's just lying. Just a liar. All right, back to
Just a liar. Gabe's coming around to my way of thinking. Thank you, Gabe.
Just a lie, just a lying piece of shit.
Liar.
I haven't got to you yet, Travis. Let's get back to Mike.
Yeah,
Mike,
that's right. You're next. You are next.
Mike, was your uncle also an investor, or was he just focused on residential appraisal?
No, just focused on appraisal. What was interesting is when I met him, so he had just gotten engaged, was getting married, having his first child, and he actually lived in East Portland in an old house that had an ADU. So I had this little detached cottage, and he rented the cottage out. And at the end of my senior school year, we worked out of that house as an office. And then shortly after graduation, he bought another house. So that's where he's moving in, starting a family. And then that was kind of suburbia. So I'd seen him own that other property, buy another property, and market conditions weren't great. This was the summer of 97. And so he was trying to sell that one property. He ended up not keeping it as a rental, but he just reduced price, but he never had an investment lens. I saw him do well. I saw him make money or make equity, but we never talked about an investment lens. At one point he bought a condo that we used as an office space. We made an investment in that condo, but investment ideas didn't come to me until 2022. So, my story is kind of interesting. I was doing an appraisal. I got my license in 2002. 2003 is when I got serious, and I went out to do this appraisal on an off-market 80-acre farm way out in the boonies. And the guy I showed up to meet the buyer, who was letting me in, and it was vacant, and I got there early and I was measuring it, and he kind of just treated me different. He kind of saw that I was different, and he's like first guy who gave me a Rich Dad Poor Dad CD. So I listened to Rich Dad Poor Dad on CD. Later, he tried to sell me into his freaking guru education program that, scared me away, but that's where I kind of got into it. And then I bought some houses in 2000. I bought my first house in 03. I started my company appraisal firm in 04, split off my uncle, and I kind of got distracted in the business side.
Wait, how old are you? You're starting businesses and buying houses?
Yeah, I'm 46. I'm an old dude. I'm 46.
Oh, wow. You're old. Ugh,
Mm-hmm.
He's not older than you are, though, Trav,
that's
right?
I just turned 48 last weekend. So, Mike,
that's
how old are you when you're buying these houses?
Yeah, 2003. So I was 24 when I bought the first house, 25 when I started my appraisal firm. And then I bought 26 and 27. I bought about 4 other properties, I think, in various, some by myself and a couple in partnerships. And then the Great Recession happened. And that's when I kind of learned a lot about real estate. I'm not the fastest learner, but I've been through so many different scenarios and experiences that I kind of now can look back on just real life stories and real life scenarios to kind of help me now move forward, I guess.
Mike, was your motivation to buy those first few properties? I mean, a lot of people mention the Rich Dad Poor Dad book. You got a CD. For our younger listeners, it's these little circular things that you put into the slot. It would play music or, maybe an audio book, right?
So we had 8-track.
Yeah.
Rich Dad Poor Dad on 8-track.
You had an 8-track, Travis.
I just wanted to beat Mitch to the joke.
Yeah.
Yeah, that's a good question. Like,
I don't even know that word 8-track, Travis. That's the problem.
Yeah.
I don't even know.
Hey, I remember my dad talking about 8-tracks too, Travis.
Yeah.
Mike, was that the motivation from appraiser to invest?
Yeah, it's just the cash flow quadrant. It's just figuring out, I wanted to get assets. So I wanted to get income. I wanted to kind of start maxing out the cash flow quadrant. So buying my first house was a very easy way to do that. Loan programs were great. I had great credit. I had cash. I ended up using tax savings to buy it and then was luckily able to pull that back out before my tax was due. But it was just to fill out that cash flow triangle. And then when I did get my cash back out in early 2004, and started my appraisal company, then I wanted to be in the B side. So I got an asset on the investment side. I wanted to be in the B side. The next purchase was an office space, and I purchased a essentially house hacked or office hacked an office space. So it was just kind of starting to build out that quadrant. And then what changed for me is the third purchase I bought was a pre-construction townhome where, I went into escrow on phase 1 of a new subdivision, Arborville, was going to get built out. And I was one of I think I bought 8 townhome number 9 out of the first 10. And my price was $220, is worth about $320 when it was actually done. So, 9 months later, I could buy it. I closed on it, like 5% down, and then it's worth $320. And I didn't want to sell it because it would have been 50% capital gains.
Right.
So it was just this,
Oregon
I didn't
too.
know what I wanted. Yeah. I didn't know if I wanted income. I didn't know if I wanted equity. I do know that I wanted to get more aggressive buying real estate, because what I was looking at was just creating an income in the appraisal business and then trading that for real estate. And it just didn't feel like it was slow. Early on, the acquisitions were not forced appreciation based. They were just, you buy them, I get a little bit of a deal. And kind of going back to the appraisal background, the hardest thing about having an appraisal background is training your mind to go from retail real estate to investment grade real estate. And I talk to this with new realtors or realtors all the time, which is for, however many years, I was just indoctrinated in, hey, 90% of real estate is done this way and it's believed to be done this way, when that's not how it has to be. And so you have to have this retraining period. And so my first phase of real estate, I was just retail oriented. It was, oh, cool, this is worth 180. I can buy it for 140. Great. It wasn't anything sophisticated. Whereas now I only want value add deals. I only want forced appreciation. And so each acquisition is a really big, you create an equity bump. And so I think early on, what I realized was I'm not going to get enough cash flow to significantly change my life unless I scale hugely and change all my operations. Equity bumps are a great way to change your life. And over time of building a portfolio and owning a portfolio and building some businesses and losing some businesses, I realized that cash flow is really just a byproduct of net worth. If you don't have net worth, your cash flow is manufactured, and it's your return on equity. It's your return on that net worth. And so I look at it now of, I want to have a really large net worth that I can turn in, get a 4% return on that net worth and be really, really happy with. That's my goal.
Can I stop you for a second and dig into that? Because I know we've had that conversation. I've had this conversation with other people offline. And it's always this interesting conversation around cash flow, equity, net worth. Like, there's people that will say net worth means nothing. There's people that say no, net worth, it's important to build up your net worth. Or I only invest for cash flow. Like, I think about my early years, I was like cash flow, cash flow, cash flow. And that's allowed me to hold a lot of properties. But my wealth has all been built off equity. And then I actually see an advantage having a higher net worth. It gives me more opportunities to financing, to deals, credibility. And so just talk a little bit, your belief and connection of why is it important to have a high net worth if you're investing in real estate?
Yeah, because cash flow creates freedom, but equity creates safety. And I've learned this through the development pipeline and this huge sales recession we've had. If I had just cash flowing assets without a lot of equity, if I had a high return on equity, I don't have a safety net. We had to liquidate some rentals so we could create cash, so we could keep our development pipeline going, so we didn't default on tens of millions of dollars of debt.
What was that like? Cash flow creates
freedom. Yeah, cash flow creates freedom. Equity creates safety. And a couple $100 a month in cash flow isn't going to change your life. But if you can sell a piece of rental property and create a few $100,000 of liquidity, that can change your life. And even, you can create a couple $100,000 of liquidity, set $24,000 aside, and you've got your cash flow and your liquidity. And so the true safety net, the true changing of your life comes through equity, not cash flow. Cash flow gets sucked up left and right. And the equity is the true reality there. I think people that are just living off, if you talk to people who are just living off passive cash flow and you really look into it, they have a lot of equity and they have a large net worth.
Well, that's interesting you say that. I dropped out for a second because I must have inherited some of Mitch's internet issues. But I mean, when shit hits the fan, and we've had some shit hitting fans over the last couple of years for a couple of the properties, Gabe and I, and even Mitch and I on a couple of assets, being under leveraged on a high value property does give you that is a moat, essentially. That does protect the castle. And then it's interesting how it's like, you're saying not one's better than the other. They're essentially connected. If you have a high net worth and you're optimizing your assets, you're going to get decent cash flow. But you said 4%. A lot of people would say, oh, I want 10, 15% on my equity. But to your point, if you're getting high cash on cash, you're most likely more highly leveraged on those assets.
No, you're taking on higher risk, right? So if I want a 5% return, because that means I can just be no risk investment. I can go buy treasuries and get my 4% return. If you've got a 10% return on your equity, you don't have a lot of equity. It's just not, you're probably about half amount of equity you truly need to make that R1 or that passive income scenario real. And you just look at it baby boomers are retiring. What are they retiring into? Fixed low risk income they're just changing their portfolio to that. And so ultimately my end portfolio, that is the goal. I want to be able to exit everything, seller carry 4% notes. And then through that scenario, I can still be a deal junkie. I can still play in the game because I'm lending to borrowers or to buyers. And, kind of what we're doing with sellers right now is we're keeping them in the game just by buying properties from them and doing deals and moving their notes. So that's kind of how I want to look at it, is I want to have a low risk life. Because they just I've been through a lot of stress, man. I don't need any more stress in my life.
Well, let's talk about some of those stresses, some of those things that drew you to this conclusion. I love your take on this. I mean, for so many years, I'm a cash flow investor, and it served me well. Cash flow allows me to eat, allows me to live. I mean, my story. I became financially free, very young, but it was $1,500 a month of cash flow. But to Travis's point, when I've had those oh shit moments, it's the equity in these properties that's allowed me to unfuck the situations when they get tricky, right? And it is that equity and net worth that allows me to make some big moves. So I love your take on that. But what brought you to that conclusion? Because I know the path hasn't always been smooth. So how did you conclude this?
Yeah, I mean, because I'm a developer, because I like to always buy real estate and I'm a developer, and you get caught in bad cycles. I'm a big fan of incremental change. And in 2021, I decided to, whatever reason, go away from incremental change. And we doubled down on a new housing code and low interest rates and a development pipeline and recent historic success that was ridiculous numbers that made sense that, hey, let's dump all of our money in here. And then you get caught in a development pipeline. And essentially we created about a 52-new unit, a 65-unit condo pipeline through 15 different development projects. Somewhere total around $20 million in debt. Going into that, it was 90% loan to cost. So we could leverage everything. We just needed 10% of liquidity to do the entire project. And in August 2022, that went down to 70% loan to cost. And so all of a sudden you need 3 times the amount of liquidity, but you're already leveraged. And the other part of it is when lending in the development world changes that much, that means all of our properties dropped in value. So now, okay, we're over leveraged on the properties we do have. We now have no real clear path to go to vertical construction loans. So that way we can actually create some value so we can sell something. So in the development world, you don't actually have value until you have an end product you can sell to an end buyer, but you have to get to the end of that pipeline. And so when you go from needing $2 million of liquidity to $6 million of liquidity, then kind of the hits the fan. And so, it was now, okay, sell some rentals, leverage some rentals. It was work with the private investors that we had, as well with our rental portfolio, to then get the additional resources we need to finish out that development pipeline.
Can you give an example of one of these? Because I'm just thinking, 2020, 21, even leading up to that, interest rates are low, money's cheap, money's easy, interest rates double, the fastest spike in history, right? I mean, ever, right? So walk us through one of these scenarios.
Yeah, no, I mean, I can give you a whole slew of different stuff. I mean, so essentially we do middle housing, ADUs and cottages, and you condoize them and you sell them. And our average sales price going into 2022 is $532,000. You take everything pre-2022 out of the equation, everything since then, except for 3 3-bedroom units are a little bit bigger that we build. Everything has been 520 or less. Our average sales price is probably now around $425, $450. And so this specific demographic or market segment we were developing and creating inventory for was affordable housing. So middle income housing is made for those middle income borrowers. And when interest rates go up, now you can't target that buyer. So for example, our local jurisdiction was removing system development charges anywhere from 30 to 50 grand per unit if you sold to someone who makes 100% of your AMI. They had to make an adjustment to that program to 130% of the AMI area median income because no one at 100% could afford the property. And then we can't sell it because we have to repay these $30,000 to $50,000 fees. And so a solution is, well, change the program to 130%, and now you can increase your buyer pool to higher income people that they can now pay the price, and you don't have to repay those fees. And so you're targeting a demographic that just got squeezed so hard that they can't pay as much, but more importantly, sales volume, absorption rate went down. And so, we were selling these things before they were sold to now you're selling one a week, maybe two a week. Can you keep the deal together? Does it sell? For example, the way demand has been having these fits and starts lately, we had the last one of our townhomes. So we have this 4-unit design, really cool. We built, I think, 4 of these. So 16 of the units were these 4-unit projects. The last unit of the last project, we were at 415. We got multiple offers, got bid up to 425. That sale failed right after tariff day. It sale failed right after Liberation Day. We're still on the market. 2 months later, we're still on the market at 390 grand. So we're down $35,000 in 2 months. That's what, 5%, 6%. That's how fickle the market is. And that's not because price, it's because of demand. It's because of demand going in and out, historic low amount of demand. It doesn't affect the existing home market as much as it does the new construction market because it's a commodity and you're competing with commodity sellers. But when the market shifts like that, you take your demand away. That's why the lenders changed. And so they went to 70% loan to cost because immediately they needed to know, well, where are we going? Where's the end demand? If we have to take these projects back, what can our basis be? And so the first thing that changes is your lending side until they start seeing the back end side. And so sometime in 23 and 24, LTCs got back up to 90%. We're kind of back into that same new construction lending environment. But for a period of time there, everything was frozen. And then as everything's frozen, you can't complete a timeline. But when everything's mostly based off leverage and you can't complete a timeline, you're just spending, we had 150, 200 grand a month of mortgage payments. It's stupid. Absolutely ridiculous.
So Mike, I feel like I'm allergic to development, by the way, just to say it out loud. I've never developed. I think I tried to do something. Anyway, I don't have the patience for it.
I've got my ass handed to me developing. So yeah.
And I've never developed anything. I've never done new construction, not even on a single family home. Yeah.
Yeah, like I think it's like, and this conversation kind of reinforces. I'm curious with what you know about long-term cash flow, forced appreciation, why development? Or is it like now you're looking back going, maybe I'll do less development? Or where's your head at when it comes to development? Because it seems like it's like when you win, but when you get, stuck, caught in a corner or a hard spot, it gets really, really tough and you're forced to sell long-term. Like, I'm just curious where you sit there.
Yeah, it's for the bigger equity bumps, that those 65 condos were just for sale projects with the thought that, hey, we'll probably, depending on how we perform, we'll hold some of them. And so if you're an equity net worth based scenario and the appraisal background, I understand highest and best use. I've had a lot of success in the land development world. And for me, it wasn't even that the development was the bad idea. It was getting over your skis, the distractions and the incremental change. A lot of these projects were profitable. The problem was we took on a couple non-profitable projects and then they were stuck in the middle of our pipeline. And so you're distracted trying to keep balls above air that you're putting all these resources into that ultimately have a net loss. But here's a really good example. We have 4 units we just got city approval to record a middle housing land division. We've had all 4 units, 4 of 4 pending for months. We're paying a $200 per day per diem to keep those freaking deals together. It's still a profitable deal. We bought it in 2021. We had one plan on it. There was a duplex. We're going to remodel that, build an ADU with the new code. That plan didn't work. We raised capital on that. I had to move a private lender to another project. We then had to delay to redesign 4 new detached cottages completely outside of all the other plans. So a brand new design, a brand new entitlement process, a brand new budget, a brand new construction loan. So instead of having that project done in 2022 or 2023, we're just now finishing in 2025. It's still profitable though. So I'm not against it. You just need to understand it. And I'll even go quickly. So on that one example, that 4 cottages, we ended up buying another property. We delayed that one. I took my lender, I had a second position lender with a 240 grand. We had another opportunity in March of 2022. So we knew market conditions were changing. We knew stuff was changing. This was a good project based on what we could do. So we slowed down the cottages, just went to design. I talked to that lender, said, you gave me a couple $100,000 for the remodel here. We're no longer going to remodel. We're going to demo. We're going to take your money, go buy this other project. You're going to give us some more loans on these other projects. We're going to build out 9 units. We sold those last year and that made $250,000 of profit. So timing matters. The projects you matter. I think the risk comes in, you just don't know what you do. Most people that make mistakes for 2 reasons. 1, you don't really understand the project, and 2, you get exposed to too much time.
Well, I just feel like I'm lazy when it comes to real estate.
We're just lazy in general.
Yeah, you have more energy, maybe. I don't know. I look at real estate maybe a little bit differently. I don't. The development side doesn't attract me because it sounds like too much. Like I don't know if I have that capacity like you do.
Well, I'm a slow thinker, as you know, Mitch, and I'm having a hard time even following Mike. Like this moved and the lender moved over here, and I'm like, either I'm stoned or I'm having a hard time even just following.
I have a DocuSign in my email and I'm like stressed about it. I'm like, I gotta figure out what that is.
Yeah. And this is my personality as well. I love architecture. So what got me into appraisal is I'm good at math. I love architecture. I like history. So, and economics, those things all bleed together. And my job as we grew out Rarebird, my job was really acquisitions and project management. So what kept me happy? Buying a lot of real estate and remodeling it. And then, gosh, these remodels really suck. Let's get it in new construction. And we formed a good, good partnerships, and we have a partner builder. And so most of the building is in their arena. We just work on the acquisition and the remodel of the existing. So I still try and stay in my lane. The way I look at it now, so my opinions obviously changed to an extent. I don't underwrite anything for sale anymore. Everything we do is underwrite for rent. I want a really, really low basis. I want a really good plan of attack. One thing I learned when you're in the middle of that development pipeline is to really run cash flow projections. We can look at spreadsheets and say, okay, our acquisition is this, our acquisition costs are this, we need this budget, we're going to hold it for 12 months with this much interest. And you can say, we need this amount of money. There's a hell of a lot better way to look at that if you actually month by month run your cash flow projections out 1 to 2 years beyond your actual timeline. And you can see where that money is going. You can see where the money's coming in. And so when you're looking at it on a macro level, that was one of the mistakes I did, is I didn't fully understand every month-to-month scenario. And so then when a wrench was thrown into the pipeline, having to figure all that out is different. Whereas now going into projects, it's not only on a macro basis, this is how much money we need. I'm running out those projections. I'm running them beyond our timelines. And then we go negative. And then we say, okay, how much more liquidity do we need? So we have plenty of liquidity on the front end. And then we base our returns not just on what we need from a macro amount, but from that liquidity bump. So we're making returns based on that. And the reason being is I want to bake in, you can do net 30-day billing on new construction. That's kind of the beauty of it, is once you get your construction loan, you can hire all your subs, you can get it to a point, they can give you invoices, you can get your draw based on your invoices, and you don't have to have liquidity in the game. I don't like that at all, especially when you have multiple projects. I want to fund that pre-phase 1 of liquidity to the beginning, so that way I'm not relying on construction draws to pay any invoices. We're paying out of liquidity and then getting our liquidity reimbursed through the construction draw. And so that's where I don't know anyone that does a significant amount of cash flow projections. I think you'll see that in the syndication world to an extent. I don't think they're really detailed to the level that I do now in the development world. But to me, I love development. I love architecture. I love saying, oh, you can take this raw piece of thing and turn it into this beautiful thing. And I don't want to allow the risk and some past unsuccesses keep me from moving forward in an arena that really brings me a lot of joy. So that's how I look at it.
I get that. I do have a question, Mike. Is there an opportunity, and this is where I'm kind of blending the two, right? Like you love the development, you love the architecture, you love that, like that's a passion for you, so you don't want to give that up. But is there an opportunity anywhere, and maybe you're doing this, you've said you've done this, to go find something, build something that's awesome, but the numbers work to rent it and hold it long term and go through a refi and cash out and get out of the deal totally and hold it? Would that be an option?
Yeah, my whole portfolio is based on BRRRRs. Everything was BRRRR, and so seller financing, low area, didn't have any So my story is in the Great Recession, I kind of ended up in bankruptcy. I went through the Great Recession. Okay. Got in a bad partnership, went to bankruptcy, and then started Rarebird after that. And so at that point, it was no credit, no cash. Seller financing was the only way to build a rental portfolio. And then it was the Burr model. So then once we had a track record of success, we get some private investors and hard money. And then so it was the Burr model. The Burr model stopped being really like 2019, 2017, 2018. That's when it stopped really making it became a lot more difficult in that arena in the Portland area. And then we also had a track record. We had a balance sheet, and now we could go do bigger development projects.
Well, real quick, just for the listeners, a Burr is something that I invented. It's called, what is it? Buy, rehab,
doesn't know it.
Rent.
He doesn't know it. He's like, I invented this.
Anyway, no, I think it's a thing that it's a term that Brandon Turner came up with. So sorry,
you just
Brandon.
buy it and then you do some stuff, right, Trav? And then something happens.
But you, real quick, Mike, you said the Burr stopped working in the People's Republic of Portland, Oregon, which we all know is communist. I'm just curious. I'm joking. What happened exactly?
Just the rent to price ratios got way out of whack.
The prices are expensive. Rent's still fairly low as a ratio to that. Okay.
Yeah. And the bigger squeeze was interest rates got so low that seller financing kind of dried up to an extent where we were still getting seller finance deals and we're getting great interest rates with it. But, when you can get a loan for 4% from the bank and you're offering a seller 3%, you're not doing as many deals. And then in those scenarios, they typically wanted more liquidity. And part of it for us was also distractions. Like the biggest thing for your audience is distractions. Starting a brokerage, starting a property management company and an education company just took a lot of resources rather than double down into, hey, here's what's going to change our life is building out the portfolio.
Yeah, I think I would rather get kicked in the nuts than start a property management company. I saw that in your bio. I was going to ask about that. Is that good business?
It has a place. So I don't like sales. I hate brokerage. I don't like other people's decisions dictating my success, but I own a lot of property. And so having an internal property management company makes a lot of sense.
Especially if it's centralized and you have most of your assets are sort of in the Northwest, right? The Oregon, Portland area.
Our assets are within like 5 miles of each other.
Oh, wow. Yeah, that makes a ton of sense.
Yeah, we did sell, I made a decision again, distraction. So we got our kind of portfolio built out and then we started taking on clients. And we passed rent control in 2019 and then COVID in 2020. And by 2021, my best resources from staff standpoint were just answering phone calls from tenants and other property owners. And so we sold off our client portfolio in 2022 to then readjust everything and focus back in on our property management company. But I look at it as we build our empire has been built off acquisition and asset management, and having the internal property management company makes asset management really, really easy.
That makes sense. How big's your portfolio? What do you guys like, just high level? What do you guys have in that 5 mile range?
It's, the entire property management portfolio is under like 250 to 300 units, somewhere around there. We have a portfolio / property manager, assistant, maintenance tech, and 1 VA. So essentially 4 people running it. And then my second in command helps out that portfolio property manager on top of kind of his duties across everything that we do.
I have a second in command too. His name's Mitch. He's a good little subordinate. Yeah. It's a good little guy over there.
And you have a second in command, and a third in command, and a 14th in command.
Mitchie, my little man.
My second in command, I actually met him by leasing him a unit when I was the leasing agent for a property management company in 2014.
Oh, wow. That's awesome.
You mentioned historic stuff. I did a historic project, old building, got a lot of money from like federal money. Is that what you're doing? Are you guys getting like facade improvement grants or like, what is just high level? What does that look like?
We did one residential. So it was done at the state level at the the Parks Department in Oregon. And so it was property tax abatement. So 10-year property tax abatement. So the project we did it on, our property taxes, when all said and done, should probably been about $14,000. I think they're $2,000. So it's about $120,000 savings over a period of time.
Mike, I had a question for you in regard to just taking all your experience. We have listeners, some who have not purchased their first investment property. Some maybe have 1 or 2 units. Some have hundreds of units. Kind of got a broad spectrum. From your years of experience, like what advice, because I know people will come to you and say, Mike, I want to invest in real estate. I want to get started. I want to scale. I want to be financially free. And I know, the advice might be different for each person individually, but just kind of blanket, someone says, hey, Mike, I want to invest in real estate. Like, what advice do you give them?
Yeah, be really aware of the tunnel vision. It's really easy to look at a pro forma. We get stuck in even analysis paralysis. A lot of people most people get stuck in analysis paralysis. Some people move beyond that and actually buy their property. But think of that acquisition outside of just a vacuum, or think of the scaling outside of just the vacuum. So for me, the comment we use with our staff is bandwidth. What's our bandwidth? What can we actually handle? It's a capacity issue. So if you don't truly understand your capacity, that's how you get out over your skis. And when you get out over your skis, not one project fails, every project fails. And so really understanding the capacity aspect, not so you don't extend yourself and get uncomfortable, but just so you don't get overextended. So you can see the loopholes coming ahead. And even like I said, run cash flow projection reports. It's great that you have this pro forma. You know what your as is spreadsheet looks like. You know what your reposition spreadsheet looks like. But what's it going to take to get there? How much vacancy you're going to have? What happens if the tenants don't move out in time? What happens if those remodels cost more? And so bring those spreadsheets to life.
What happens if the city tells your tenants they don't have to pay rent for 2 years? What's it called when you're being generous with other people's money, Mitch? Socialism? Is that what it's called? Sorry.
The best thing about socialism is there's always going to be buckets to fill. So you can just find some other bucket to fit in the way if you have to fill someone else's bucket. But if you bring it to life, then you can see potentially how this creates trade-offs, because there's trade-offs in everything you do. Scale comes with a lot of trade-offs. Your own personal time, your own personal relationships, obviously. So I think just look outside of the vacuum. Don't get tunnel vision.
I love that. I love that on our call, we have the guest speaking and then Travis is in the background yelling about communists
and socialism.
That's what it feels like often. They're like, so then I got into real estate and I read Rich Dad Poor Dad and he's like, a bunch of communists and socialists and blah. I'm like, all right, you know what? Someone's got to mute his mic. Mike, let me ask you a question. Where are you going from here? I know you've been through a lot. Ups and downs, made a lot of money, lost some money here and there, plugging some hole. I mean, you're like the quintessential, I just look at you as this, you just can't kill you and you're going to make it and you survive and you're doing, and now you're doing well. So where do you go from here?
I was literally just thinking, are you calling me a cockroach?
Yeah, I wasn't going to say that.
Mitch was calling you a cockroach.
Yeah. I was actually going to call you a communist, but I don't know why. So no, I'm joking. So Mike, where do you go from here? What's your strategy going forward?
Yeah, it's close out the build to sell pipeline. That's almost done, so we'll close out that pipeline. I just sold a couple flips that I just wanted to get off the pipeline. It's switching from, I've been in I went from a 70-30 develop to hold to a 90-10 develop to hold, and I want to get back to a 50-50 develop to hold. So I'm forming new partnerships, doing more of not a syndication, because I know all the people that I'm partnering with, but the actual people, members of the LLCs, don't know other people. So it's pooling money of consistent relationships that I know to buy bigger assets and do more Burr method in those asset classes. And that was, as you're going through, I'm trying to build for the future, is kind of getting out of that pipeline. So to answer your question, I bought a care facility. So I bought a senior care facility. Last year, we're converting it to a mental health detox care facility. And again, we can complain about the Socialist Republic of Portland all we want, but Medicare just went and did inflation adjustments on their contracts for the mental health, and they're huge. And so there's been this huge demand for these types of properties, and we were lucky enough to find a pretty quintessential property that works really, really well for this model. And you can't actually do the detox use with the zoning that's there, but because I know code and I own no development and grandfathered uses, there's a pretty easy pathway to convert the use based off this grandfathered scenario. So that's where the appraisal background creates a lot of value.
Tell us about that property, Mike. I've seen some pictures online that you've posted. It looks like a really cool project. I personally think there's a huge opportunity in this space. I mean, whether it's adult foster care, adult assisted living, memory care, some of these larger properties, residential, but converted more to a commercial type use.
Yeah, it's a really interesting world, because mostly what you have is you have small owner operators, and then you have big properties where people own it and just hire operators. And there's no one in the middle. So when we were looking at the senior care facility, that's what we thought it was. We thought it was going to be a senior care facility. But what we found is there was no way we could find anyone to operate it. And there were some other problems with the building itself. And I had already been in touch with mental health. We'd already bought and sold another sober building. So I knew people in this space. And what I found is there's a huge niche out there. If you can find medium-sized buildings where they're too big for owner-operators, but they're too small for investors to buy and then find a tenant, you can buy them. And I don't want to be an operator in the space. The last thing I want to do is start another company.
I was going to ask you about that if you're planning on operating the business.
Yeah. And then the nice thing is now because you have so much more demand, there's more money in the mental health space, which means you have more businesses created in the mental health space, which means you have more tenant demand for facilities in the mental health space. So you may not be able to find a building that you can put a senior care operator in, but there's plenty of mental health care operators.
I was gonna say, I'm seeing a lot more of this. We've got a guy in our elite group that, I don't know if you know Brian, right? Brian, I won't get into his last name, but
yeah. Oh, I did.
Well, he's buying these large houses and turning them into, and he leases them out, kind of like a triple net lease to these operators for sobriety, right? Sobriety stuff. So that's like interesting niches that people are finding, sort of like these pseudo triple net stuff. I mean, you mentioned mental health, there's memory care, there's these smaller sort of boutique senior care facilities. Is that kind of what this is? Is it like a small house, is it like a large house?
This is not that. This is so there's a U-shaped building with 2 wings. Each wing has 13 rooms. So one wing is double bed occupancy. So the one building had 39 beds.
That's decent size.
Yeah, then there's another 13 beds in this other wing, like a detached. There's a detached structure that has more suites in it. And then there's a cottage building, and then there's a detached house, and there's a detached garage, and it's all on 2 acres. So the majority of these spaces, you're correct. It's a small house, or for the detox, you can't do detox out of a small house. Residential zoning, this doesn't work. So they're in these office buildings. And it's terrible. It's terrible for the other tenants in the office buildings. It's terrible for the patients that are going into it. And so we had to go through this grueling process with the state and the city to get an approved use. And our tenant's been sticking in there this whole time because it is such a unique space. So think of who their clientele is. They're going to have 20 patients, 25 staff, 24/7 staffed. They've got a courtyard. They've got a lot of outdoor space. They've got a place for people to truly repair their mental health. Whereas typically, all the services get thrown downtown where all the drug dealers are, where all the homeless activity is, and you just can't get out of the space. You may for the 8 hours that you're there in the building, but you can't get out of the space. And so we're now 5 to 6 miles away from downtown. It feels like you're out in the country. It's a completely different component to it. I'd say the houses are this is where understanding structural code is really important. Once you get more than 6 non-related residents in a structure, you get issues. I know one of your other elite members in Oregon is having an issue right now with an Oxford home because they got neighbor complaints. And so, a neighbor complaining can shut your project down immediately. If you get a notice from the state that says, hey, you're violating this structural code, you need to do an occupancy change, you need sprinkler systems, you need a full life safety upgrade. So you need to understand structural code. For example, on this building, we were able to avoid a whole lot of that. We had a lot of the systems in place. We had a fire sprinkler system in place. So going from a small operation to a large operation is commercial in nature, and it's 2 completely different beasts. So you either stay small or you go big. It's hard to straddle the line in the middle.
So how do you overcome the more than 5 non-related individuals living together? Because I know there's folks all over the country, all over the state, in Oregon, we're in Oregon too, that are, doing these, whether it's Oxford or some other kind of larger, more than 5 non-related people living together.
So, every property has a zoning, right? So the zoning said this is what you can do based on zoning, but each property also has an occupancy, and this is what your occupancy can be. So for all the single family homes, the zoning says you can have a single family home and their occupancy is a single family home. And the residential side, you have, R1, which is 30 days or more. And then you get into the commercial occupancies, which is less than 30 days, the R2s and the R3s. So the R2s and the R3s are, less than 30 days with no services, less than 30 days with services. And so and that's the structural code that says it. So for us, the reason I can do in this care facility is we're residential zoning. You cannot do these level of services in a residential zone. But the senior care facility is an institutional use. So we have this grandfathered institutional use that is the same use. The description for that use is the same use that applies to the detox facility. And so we're using that same use category in the structural side to override what planning and zoning will allow us to do. And so when you're doing an old house, that's the problem. You're in a residential zone. The residential zone does not let you do more than 6 non-related parties. So if you get 7 residents in there, now you violated zoning. If you get a complaint, now the city is going to look at it and they're going to say, yep, you now have 7. You are beyond the R1 use. You're into a different use. You're in a use change. You either need to vacate the property and start over, or you need to actually convert it to this other type of use if zoning allows you to do it.
How do banks look at these kind of unique properties or these unique use cases?
Most of them won't touch them. You have to go to special lenders. Luckily, I got in networking. The best thing about real estate networking is you have to think of it as an infinite game. I met a guy who works for Berkadia. He's been doing loans on these types of facilities for almost a decade. I met him 6 years ago. She just reached out. He's like, hey, I saw you bought this building. It's like, great. Yeah, I did. We are going to need an institutional loan. And now he's kind of helping me navigate down that road. But there are special lenders for special use projects. And so it's needing and understanding those. In this project, we kept the seller in a subordinate position to begin with, and they can go to an unrecorded position. So we have a lot of equity. I think a lender will probably look at it as worth, a maybe $4.5 million building. Maybe we get an appraisal and it's a $5 million building and we only want a $2 million loan. So very low LTV. Our DSCR, I think, is over 2, the way I underwrite it for the loan. And then we have really good terms on the seller financing. So even the global DSCR is very high. So I have all that stuff really baked into it. Worst case scenario, we can go syndicate some debt to refinance out of it.
So I know we're a little past the top of the hour. I had 2 more questions. One is, what other asset class is this like where you want to do this type of property? Do you want to do multifamily? Just high level, what asset classes are you most interested in over the next 5 years?
I prefer housing just because that's my background and it's very, very easy for me to do. I think as I start building out some more 50-50 portfolio versus development, I'll start getting more out of development. I think industrial is a very good runway. I think that's a really, really good asset class. I don't like storage. Not a fan of storage. Anytime cap rates compress by 100% 50% in a very short period of time, it bakes in a basis that is very difficult to use. So, just from a broad acquisition standpoint. And then I'm not really excited about venturing outside of Oregon because bandwidth is a big issue for me and I want to keep my team involved. And so being local makes more sense. And I just have to get so specialized in the acquisition to get in like a storage asset class. Housing's nice. It's just so easy to underwrite. It's so easy to understand the patterns, the cycles, the demographics. Absolutely.
Until the robots kill us, we all need a place to live.
Well, and that's the thing is with AI, I don't think anyone knows what the commercial asset space is truly going to look like in the next 10 years. And so I'm not really excited to sign up for 10-year loans in the commercial asset world.
Don't rent to robots. Secondly, if you've ever been to Investor Lab, Mike gets up there. He drinks about, maybe 4 or 5 bottles of wine. And then he gets up in front of everybody and he gives his forecast. It's actually really entertaining. That's like my favorite part of Investor Lab.
It's a true form of infotainment. Yeah, it's true form of infotainment.
He does a great job. I remember being there, Mike, you're like, how much do you care about, economics, Gabe?
So Mike, what is your high level? We don't need to get into the nitty gritty. You don't need to present like on a macro basis, like where do you see real estate investing? We got interest rates, we've got wars, we've got cost of living, we got cost of materials, what do you see?
I'd say, you can go back and watch episode 2 or 3 or whatever it was where we did I think it was 2021 when we first spoke. That hasn't changed a whole lot. The whole extend and pretend is just here to stay. Maybe we recorded in 22.
Refresh me, extend and pretend. Remind me what that is.
Yeah, extend and pretend on the commercial side of debt, right? So the problem on the commercial side, outside of office space, outside of just market segments where demographics suck, you don't have a problem in the commercial world. Multifamily is mostly okay. Industrial is mostly, it's just the maturity dates. And so it's these technical defaults coming up, maturity dates that then create liquidity crunches. Liquidity crunches create problems. We don't want any problems. So it's a lot easier to just extend the maturity date and pretend like we don't have an issue. So the first comments early on was stay alive till 25, and then it was persist till 26. So now an extension of that past episode is I am concerned we're getting into a scenario where we're going to have a depression in 27, at least for a lot of sellers. So think of it this way. The reason the extend and pretend happened is because out of $5 trillion of commercial debt, $3 trillion of it was due to mature and reset between 2022 and 2024. How much of that 3 trillion, 60% of that debt, do you think has actually been releveraged or deleveraged or reset on new actual either sold and that loan was taken out, or actually refinanced and that loan was put on a new time schedule? The majority of that $3 trillion of debt has just been extended. And so now, instead of refinancing $3 trillion of debt over 3 years, we could get to a point in 2027 where we're trying to refinance $3 to $4 trillion of debt in 1 year. That's terrible, because you'll have so much demand for debt versus how much supply for that debt. And so there's, the debt cycle is a concern in that arena. The bigger macro levels, I just think we're tapped out from an economy standpoint. The cost of housing, the prices of housing are locked in due to low interest rates and now loans that last a long period of time. And so we're way more tied to interest rates than we ever have been. We used to have anything from an affordability equation standpoint, the residential side, anything above 100% is good. It means you can afford your mortgage and then some. Anything under 100% is bad. In Portland specifically, our historic timeline over the past 3 years, we've been hovering above 115 to 130%.
Wow.
We got down to 100 in 2004-05, just under 100 in 06. In 2022, we were down in the low 80s. And right now we're like 88, maybe 90%. And so what that means is small changes in interest rates in the past never really affected anything. Demand was consistent. We just was like, okay, we went from good demand to more demand, or from good demand to slightly less demand. Now we have very little or very little demand. So if we get a bump down in interest, okay, we go from very little demand to less little demand. If interest rates go up, we go from very little demand to no demand. That's problematic. And so that's where inventory builds, which is a good thing. And I think one reason the Fed hasn't jumped in to salvage anything is because we need inventory. Because if we lower interest rates and now all of a sudden effective purchasing power goes through the roof, and now all of this demand's like, oh, we can afford all these things. Let's all go make a bunch of offers. If there isn't inventory on the market to withstand that initial wave, people want to buy homes. There is plenty of demand. The effective demand is low. That can change overnight. And if you change demand overnight, that supply levels, the inventory can be absorbed very, very fast. So we're in this really sensitive component where we kind of slowly need to bring in interest rates down and kind of keep inventory elevated. So that way we can bring the price of homes back down to the inflation line, just the normal inflation line. Ultimately, historically, we want homes and the line of home prices and the line of inflation increase to be in step with each other. And right now, house prices are too high for that. So what changes all that is trade wars and actual real war. What is really scary at this point in time is we've had multiple instances of rockets in the air, and typically that would be a flee to safety. Flee to safety means people are buying bonds or buying American debt, then our interest rates go down. And that is a good thing for the real estate market because it increases effective demand. Every time we've had that happen, we've not seen a flee demand. So we don't see a huge appetite for American debt right now. And I think we don't see a huge appetite for American debt because of the trade war. So a lack of trust with our American government.
Yeah. People oftentimes forget, they think the overnight rate that the Fed sets a lot of your mortgage rates, but it's really tied to the treasuries. And treasuries if you have a lot of demand for treasuries, it reduces the yield, which reduces the demand, or which reduces your effective interest rate. So something it's taken my tiny little brain a little bit to get around. So yeah. So what do you do? Last thing, recession in 27. That's scary.
Not a recession, a depression in 27, meaning, and I mean from a seller mentality standpoint. So if you're the property owner in 2023, it extends to 24 and then extends to 25, and then that property owner isn't going to have a back end solution. Well, where does your back end solution come from? If you extend and extend and extend, you need lower interest rates to get your DSCR and WAC so you don't have to bring liquidity to the table. If you don't bring liquidity to the table and you don't get better interest rates, you need to sell the property to get that debt off the record. if you can't get that amount of debt off that record through a refinance, a new buyer can't get that amount of debt off the record through a new purchase. And so the depression is those individual vacuum property owners that just think, hey, I can extend and pretend all the way in, and then ultimately we'll have to pay the piper. And so what we've seen is the commercial acquisition side has been really, really slow because you haven't had capitulation. You haven't had good enough deals for buyers to really take action. Right now, it feels like, or about this time last year, it felt like the commercial market was going to start heating up. And then it did. And then we had the rate cut and the rates went down. And then the Trump presidency took over and then everything froze. And we had this big butt pucker of money. So we have this big money pucker. It does feel like on the commercial acquisition side, sellers are coming to the reality of extend and pretend is probably not a good thing. I should probably look at doing some creative deals now ahead of time. And so there's some sellers that are going to get out of it and be smart. And there's some good acquisition opportunities right now for people that can communicate with those sellers. But I think there is going to be some scenarios where some sellers are like, oh man, I waited and waited and waited and I just went out and I want to get out. And so there'll be some blood in the water. And then on top of that, any big reposition project in an area, they suck. You know, any big reposition project in downtown Portland's terrible. Any big reposition syndication in Texas, good luck. You know, just because no one's going to refinance that debt and you have to bring so much liquidity to the debt. And then you think about it is these big syndications, the LPs are the losers, right? The bank isn't the loser. They may take a little bit, but it's all the LPs that get wiped out. GPs can walk away easily. So the solution typically comes at the bank level. You know, the syndication defaults, the LPs lose all their capital. Either the property goes back to the bank or someone can short sale and negotiate with the bank, or someone can buy it subject to the bank note and renegotiate that bank note because they have a better basis. But all that stuff still needs to come out of the system as well. So there is true distress that needs to work out. There's fake distress that ultimately needs to come meet its piper. And with wars and trade wars and, Doge and then the spending bill, Doge doesn't matter when you add $2 trillion to your spending bill. So why would anyone want to buy American debt? And if no one's going to buy American debt, then how are interest rates going to go down? If our interest rates go down, how do we get out of this leverage scenario? I do think the one saving grace is in the trade deals. I think if Trump can get other countries to buy significant amounts of our debt with the agreement that they'll hold it to maturity and never bring it back to the open markets, is the only good way to lower our cost of debt. It won't take our debt away, but it will lower our cost of debt by adding supply to the markets through their acquisitions and removing supply to future markets by forcing them to hold it to maturity. So I think that's the silver lining I'm looking at for the tariff negotiations is debt acquisition from other countries.
Mike, this has been an absolutely fascinating episode, and we won't let you get out of here without asking our final question that we ask all our guests every week. If you were to lose it all tomorrow, you don't have your net worth, you don't have your real estate, and you don't even have your network. So you wake up tomorrow, you're sitting on a buddy's couch, your buddy's in the same position you're in, so he's not a lot of help, but you still have your knowledge. What do you do?
I would walk into a title company, get a list of free and clear property owners and go talking to all the free and clear property owners. And so the easiest way to print money is through debt. So you go create a seller finance note. That's printing money because you just created debt. And then you have a plan of how to liquidate that debt or what to do with that debt. It's just the American government. I think the best thing about real estate is we can act like the government in the fact that we can create debt and hold debt and use debt for our benefit. So I would look for places, free and clear owners to create debt.
That's a great answer. Mike, thank you so much for being on the 0 to 100 podcast.
Thanks for having me, guys. Always a pleasure.